Marcus. And thanks everyone for joining us. I also have two kids, so hopefully they don't come barreling in here in the next few minutes. They'll give us the 30 minutes that we need to have this conversation. But again, I appreciate you joining us at 7 o'clock on a Wednesday. Hopefully this will be chock full of information and insights that hopefully you find helpful. And maybe we'll hit on some things that you might be thinking about and give you some positive outcomes from our discussion today. So as Marcus and Emmett mentioned, if you have any questions along the way, just feel free to throw them out there. The more interactive this is, the better it is. So we'll kind of dive in from there. And just to kind of give you guys an idea of Russell Investments and who we are and why we're having this conversation. You may have heard of the name before through different indexes that we've created or portfolios that we have. But just as a piece of knowledge, for you, Russell, we're one of the world's largest institution and pension consultants. So we advise on somewhere close to $3 trillion for the likes of Alcoa, Boeing, Coca-Cola, Caterpillar, Delta Airlines, Aetna, AT&T, and all the way down the line. We do essentially three key functions for the organizations, and we've been doing that since the late 1950s. Number one is manager research, so scouring the universe for different money managers and portfolios of all different shapes, sizes, styles, disciplines, and flavors. Number two, we help those organizations put them together in portfolios that make sense for their particular organization and their needs, right? Pensions, they're trying to make sure checks show up in perpetuity for pensioners, and endowments and foundations have mission statements they need to fund. And then last but not least, we help those organizations navigate them through different market, economic, and business cycles. So much like we're doing today, having insights into the economy, insights into the market, helping people make decisions on the different areas that should be tweaking, tilting, or things that they should be thinking about when it comes to their portfolio. We've been doing it for large pools of money since the late 1960s, and we continue to do that today, as well as for individual investors like yourself. So that's the angle that we're coming from, providing as much information to help you navigate their portfolios and these market cycles as much as possible. So with that being said, we'll dive right into some of the information here. We're going to go a little bit fast and furious. We're not going to be data heavy, so don't worry about that. But we will hit on some of the major topics of the day, including inflation. I know that Marcus mentioned that you touched on a little bit of this mid-year. Well, guess what? It hasn't gone anywhere. In fact, it's been a little more stubborn than some would have thought. There was a period of time over the course of the summer where the market was anticipating inflation kind of falling off a little bit more rapidly than it has, and actually thinking that the Federal Reserve might have an opportunity to pause or slow down their interest rate hikes in order to deal with it. What we've seen is that has not happened. Inflation stays stubbornly high, not only in the U.S., but across the globe. Now, the U.S. is in a little bit better position than some of our folks across the pond, but not that much better. We see here both Europe and the UK at north of 9%. And you might say, wait a minute, why is Europe and UK separated? I thought the UK wasn't Europe. When we think about Europe, we think about the EU. And a couple of years ago, we had Brexit. So the UK exited the EU. So now data-wise, we actually split them up. So both of them are kind of in some hot water in terms of inflation. US, again, at higher than 8%. When you think about core inflation, so you take out food and energy, which are the most volatile components, we're sitting in closer to 6.5%, so a little bit better than that. But we actually have seen inflation kind of peak up a little bit over the summer, and we're only now seeing it start to crest or to flatten out. So the month over month hasn't been great, but we have started to see a little bit of a dip, although not meaningful. But what we are seeing is, signs that inflation might have peaked. Remember, the Fed has been very, very aggressive in terms of raising interest rates, but that doesn't necessarily mean that those interest rate hikes have an immediate effect on inflation. It takes a little while for those interest rate hikes to make their way through the system. And we only started seeing interest rate hikes starting in March. So we're only 6 months into this. So as aggressive as the Fed has been, we haven't seen necessarily the effect of those interest rates in the economy. We'll probably start to see them this quarter and maybe obviously into the early part of next year. But that's one of the reasons why the data that's been coming out has been so strong from an economic perspective. The economic numbers have been pretty robust, that it's given the Fed all the ammo they need to continue to be aggressive. And they will continue to be aggressive until they don't have to be. So a question I often get is, when do you see the Fed starting to kind of not necessarily be as aggressive as they are and start to limit their tightening? Well, when the data tells them to. Right? They waited for the data to get to the point in which they would start increasing rates, and now they're going to do the same thing on the backside. Except don't necessarily think that a slowdown of interest rate tightening means a reversal. Typically, after the Fed pauses, which could be at the beginning of next year, maybe first quarter, some time frame. There's usually about a 3 to 6 month period before the Fed actually turns and reverses course, where they start to loosen monetary policy. So what that means is, economic numbers are coming in pretty strong. You're starting to see some unemployment numbers start to show a loosening of the labor market and labor numbers, but not enough to give the Fed any sort of worry. Remember, the Fed has a dual mandate: price stability, which is inflation, and unemployment. Unemployment hasn't gone anywhere. In fact, those numbers have come through pretty strong the last couple of months. So the Fed only has to focus on inflation. And that's why when you see you see labor numbers come out or job reports come out, and they're actually good, right? We're adding jobs, and job openings are going down. You would say, oh, that's great news for the economy. Why is the market selling off? The market's selling off because if the job market is still good, that means the Fed only has to worry about inflation, and they're gonna beat that over the head with interest rate hikes. So the market looks at that as a negative. When you start to see labor numbers loosen up a little bit, job openings come down, and you start to see a little bit of an increase in unemployment, that's when the market will start to look at those numbers more appreciatively. And the Fed really won't be too concerned about that until you get to about the 4.5% mark. Why? Because the Fed looks at 5% as their threshold, and we're really far below that. We're a generational low of 3.5%. So the Fed really doesn't have to worry about unemployment until they do, which, we'll see what happens over the course of this quarter and early part of next year. But as the interest rate tightening starts to get through the system and starts to slow down the economy, hopefully you start to see the labor numbers come in line where the Fed can start to say, okay, we're seeing the cooling of the economy happen. Maybe we don't have to be as aggressive with interest rates. So now let's talk about recessions. Marcus mentioned, recessions earlier, and the debate has been, are we in one? Are we not in one? Have we been in one? Will we be getting to one? The answer is not necessarily clear. But the technical definition, or the one that most people have followed for a number of years, is 2 consecutive quarters of negative GDP equals a recession. But technically speaking, the Bureau of Labor Statistics, the Bureau of Economic Research actually is the one that determines that. And the way they define it is a meaningful reduction in economic activity. So minus 1% or minus 0.5% economic contraction is not necessarily to them meaningful. Now we know, or you might feel that you're in a recession, even though the labor numbers aren't necessarily showing it. But third and fourth quarter, we might actually see 4 consecutive quarters of negative GDP, which would really lead to you to assume that we've been in a recession. But if they're modest decreases, that department or that organization or bureau might not necessarily consider it a recession. But it doesn't really matter when they actually make the declaration. If you go back to 2008 and 2009, the Great Recession, that bureau, that government agency, actually didn't declare a recession until 2010. Now, I think anybody who was alive and experienced that all knew in 2008 and 2009, we were in a recession. We didn't need them to come out 2 years later and tell us we were in one, because by that point, we were already out of it. So the market usually leads us into one, meaning they foresee it on the horizon, and they also see the coming out of it ahead of time. So if you're waiting for this organization, or you're waiting for the government to tell you we've been in a recession for you to do anything proactive to your portfolio, not a good idea, because the market has already probably left you behind. So the market anticipates both the recession as well as the recovery. So timing is not necessarily something that you want to get caught in. So when we think about what the Fed has been doing from an interest rate perspective, they're trying to, and they may say out publicly, they're trying to have a soft landing, which means slow down economic activity without necessarily getting a recession. Let's be clear. Chairman Powell is focused on inflation. The last thing they want to do is make the mistake of the late 1970s, where you raised interest rates, you paused, you pivoted, you started decreasing rates, and then inflation came back 2 years later. He wants to make sure, and the rest of the Fed board wants to make sure that they stamp it out for good this time. So they're going to be error on the side of being more aggressive than being too dovish. And if that means driving the economy into a ditch, albeit a small ditch, they're going to do that, right? Because they believe that the economy has been red hot, actually not red hot, white hot for so long that it needs that kind of slowdown. And that when we do hit a technical recession, it'll be mild and shortened in duration. So, if you looked at, recession risks right now, obviously they've increased. You've seen some headlines in the last couple of days about recession risks increasing, where most economists are showing one. It really doesn't matter what that says. We'll likely hit one. Who knows how long it'll last? But by the time you figure out that we're in one, we're usually on the way out.
So Tom, real quick on there before we head to the next slide. It sounds like, just kind of to summarize, what you talked about there, the stock market can, be starting to recover even before, the economists say that we are definitely in a recession, or we were in a recession. Is that right?
Without a doubt. You don't want to wait for that signal to do anything, because, like I said, the market usually will take off before then. Just like leading into it, you might see economic numbers be very, very strong, and you wonder why is the market selling off? Well, because they know what's on the horizon. They know when the Fed raises rates, it slows down economic activity. Economic activity leads to a slowdown of the economic picture, and that'll eventually lead you into a recession more often than not. So what you're seeing over the course of the last 9 months has been a product of that. And then, maybe early to mid next year, the market may start to have more better days than bad days, right? Volatility is not going away, but you might start having more good days and bad days, and you start to see the wins pile up. It might not be obvious at the beginning, but you have to be invested in order to make sure that you get those good days. Otherwise, you miss out on those great days, and therefore, you do yourself a disservice from an investment return perspective.
Right, absolutely. So, and when we hear things like from, the IMF representative who recently said, hey, the worst is yet to come, how should we take that with regard to, looking at, is this impacting, the economy, and are we heading into a recession? Does that mean that I need to start protecting my assets as well? And I think you kind of, answered that a little bit, but just to bring up kind of another point that, folks might hear on the news a lot of times.
Sure. The worst might be yet to come from an economic perspective in terms of the readings, but not necessarily from a market perspective. There's been plenty of periods in which the market performed really well during a recession, because it already digested the bad news and anticipated it ahead of time. They didn't wait for the headlines to hit. So again, kind of how the market leads you in and leads you out. The market doesn't wait for the bad news to hit the headlines. They've already made their decision. They've looked at slowdown in economic activity means profits and earnings start to decrease, so they start to discount those. They start to look at the effect of higher rates on some of these companies and what the impact there, so they start to discount ahead of time. They don't need necessarily the government or other agencies or research to come in and say that, we're in the middle of a pretty tough. The economic numbers may start to look uglier as we move along, but it doesn't necessarily mean that the market will react the same way, because much of that has been baked into what you've seen already. The market's off 25% or 20 to 25% for the year. It's taken a lot of the brunt of it already. So is there some downside? Sure. But if you're thinking that we have another 2 or 3 legs down from here, you might be overthinking it just a little bit.
Perfect. Thank you.
So when we think about interest rates, that's one of the big things that a lot of people have said, and it's caught some investors by surprise. That they say, look, I anticipated potential risks on the equity side, but on the fixed income side, that's one that I wasn't really expecting it. That's supposed to be my safe haven, my ballast, my offset, my happy place where I don't necessarily have to worry about volatility. Well, unfortunately, when you start at a 30-year high of interest rates back in the 80s and you come straight down over the time, not only does that not only do bonds become a nice place to be when equities start to get a little frisky, you also get a nice return out of bonds, right? As interest rates come down, bond prices go up, which give you a good return. So yes, you've gotten some volatility in bonds that you didn't expect, but you also got, on the last 10 to 20 years, returns out of fixed income that you never would have expected. High single digit, low double digit returns out of a bond portfolio was almost unheard of 20 or 30 years ago. But that has been a big driver or accelerator to returns. So you were getting basically jet fuel on both the equity and the fixed income side for a good period of time. This is one of those rare instances in which you see equities and fixed income down. But again, fixed income took the majority of its hit on the front end of the year simply because of the fact that rates are rising. Interest rates go up, bond prices come down. They work in an inverse relationship. But as I mentioned earlier, the Fed has already done about 2/3, if not more, of their interest rate tightening cycle. So bonds have already taken the hit. So going forward, when we get into potentially a recessionary environment, bonds actually historically do well in those periods. And because rates are already high, there's not that much downside left. And they then return to be that ballast, that offset, that safe place where people go when they don't want to be in equities. Over the last 6 to 9 months, they haven't been that place because everybody knew the Fed would be tightening and they didn't want to be caught there. So they went to other places. But going forward, bonds may actually be that place again, and it might normalize the return pattern. So one of the things we have up here on the slide deck is essentially to say, what is the impact of overall returns if rates go up or stay unchanged, or toward the middle of next year, the Fed actually pivots and goes in the opposite direction? Well, look at this. If rates rise 1% from here, and many would say that the next 1% rise in the Fed funds rate is already baked into bond prices. Well, if that does happen, there's a higher yield also attributed to that, right? Because we've come off of 0 and we'd be much higher. We're 3.8% now. Another 1% rise in interest rates would put you at 4.8. Even if your NAV dropped or your prices dropped around 6%, when you factor in the new income and the yield you're getting from that, you're actually only down about 1.5%. If the rates stay pretty much unchanged from here for the most part, you actually increase your return by the yield of 4.8%. And if you're looking at next year and rates actually fall, well, guess what? You get the yield plus the price increase as interest rates come down, prices go up. So actually, you would start to get a return reminiscent of what you get in equities, 11%, somewhere in there. So from this point forward, our mid to high single digits in bonds, from a return perspective, possible? Absolutely. It's something that you could potentially look at. And then we all know getting out of the downturn, equities are going to do your heavy lifting, right? Stocks are going to do your heavy lifting. But in the short term, bonds may be able to help you get you there a little bit as well.
Are you able
one
to
thing
just
to note,
briefly explain the difference between a yield and a price return? Because I feel like, so often we talk about equities, we talk about stocks, and I think that's pretty easy to understand the valuation growth. But I feel like bonds are oftentimes left by the wayside and used strictly for protection. So can you just, briefly explain the difference between a yield return and a price return?
Sure. That's a good question. So bonds, all bonds are debt instruments, so they pay a yield depending on the attractiveness of the company or the government debt. And so essentially, when we think about a yield is what it is paying in terms of a dividend on a monthly, annualized, but how it pays out monthly or quarterly, right? So if you're getting 4%, that's a 4% yield. All things being equal, 4% is what you're going to get from a yield perspective. When we think about price return, well, bonds don't stay, the price of a bond doesn't stay static, because as interest rates move, that 4% yield you're getting either makes the bond attractive or not attractive, right? Meaning if I can get a higher rate somewhere else, I'm going to sell this bond and the price is going to come down. So the price return we're talking about is the movement of the actual price of the bond. The yield stays relatively static, right? A bond actually has a fixed yield, but that yield can go up or down depending on what the price is. If the price is not, so if you think about $100 as a par, if the price comes down to $95 and I buy it at 95, well, my 4% yield is not 4%. It's actually higher than 4%. Right? So there's a difference between the yield that comes from a bond that is guaranteed, that's going to come through, and then the return is basically what is the market willing to pay for that bond. And if you've got a bond fund, which a lot of people will do, you buy a bond fund, let the portfolio manager deal with it. That's where you get some movement of price of the underlying bond portfolio, and then you obviously have your yield. So there's two components of fixed income. There's yield, and then there's bond pricing. So hopefully that didn't muddy the waters too much. Bonds are a very interesting market, and
a lot of dynamics that play with them. Yeah,
absolutely. And one thing a lot of people don't realize is the bond market is about 3 times larger than the equity market. The bond market is so much bigger and so much more important in terms of being a predictor of economic activity. A lot of people say the bond market leads you before the stock market does. So if you can't figure out what's going on, look at the bond market, and that'll give you direction.
Interesting.
So if we think about recovering from the losses that we've seen now, again, this one of the things that's interesting about this slide is we're just talking about equities here. So we're not talking about a 60-40 portfolio or a mix of stocks and bonds. We'll get to that in a second. But if you said to yourself, you know, the market's down 20 to 25% from an equity perspective. All the indices, Dow Jones, S&P, Russell 1000, whatever you look at, all down in the neighborhood of 20%. You say, wow, we lost everything from the last bull market. No, we haven't. Not even close. So if you think about it, we've had a 10-year pretty much straight up line, with the exception of a couple periods where we had some volatility, but no meaningful drawdowns or declines in equity prices. So what you're seeing now, sure, it feels pretty bad. You know, and 20% is nothing to shake a stick at. It obviously is a meaningful decline, but it doesn't wipe out your 10 years worth of returns. You know, equity prices have still done really well over that time frame. What you've seen is that this decline or this drawdown maybe has brought you back 2 to 3 years, right? That's about it. But it doesn't stay down there, right? Equity markets reprice, and then much like the seasons, they start to grow again. So what would it take based on the drawdown that we've seen so far to make all of your equity returns back? Well, if you're down somewhere between 20 to 25%, you actually don't need 20 to 25% to get back to even. You need 30+%. So what we see here is the 1 year number being 32.7 based off of what the end of the year, the end of the quarter returns were for the equity markets. That's not unheard of. 2021, the market was up 29%. In 2020, during COVID, market was up 21%. 2 years before that, it was up 37%. So the market is very recent history has been up more than 20 to 25% in a number of different years. In fact, over time, it actually has happened 9% of the time. So call it 10% of the time we've had market returns above 30%. Or over a 2 year period, right? What do we need to get back to even? Just north of 15%. Is that impossible? Absolutely not. It's happened almost 40% of the time, right? So large market increases are actually something that's relatively common. And then obviously you go back a little further or go out a little further. If you have a 9.9% return, or just call it 10%, you recover all of those losses in 3 years. That's happened 2/3 of the time. So is it impossible for it to happen on a quick basis? Absolutely not. Could it take longer? Absolutely. But what's the track record for the market of recovering returns? Very good, right? So if you had confidence that with a high degree of probability, the market returns and your asset price would be higher in 2 to 3 years, would that make you look differently on the environment right now? And instead of it being a negative, could it potentially be a positive for you? Are there things that you and your advisor could do to help you get out on your front foot to actually take advantage of this? Because if I know that if someone, you know, it kind of seems scary at the time, right? You want to hunker down, you want to get conservative. But if you said, hey, wait a minute, in 2 to 3 years, we're going to be higher from here, and I've got a 20-year time horizon, maybe I don't want to be defensive. Maybe I want to be aggressive. Maybe I want to, you know, get on my front foot and take a different stance. I would probably look at this through a different lens if I knew with a high degree of probability that we were going to be out of this in a short order. But what should you not do? Well, based on current yields, if you went to cash thinking that was a good idea to kind of hunker down, how long does it take to get back to even given the returns in cash? It would take you almost 10 years to get back to where you were a year ago. If you went into bonds, a 10-year, a 2-year, a 10-year, or 30-year, it would take you somewhere between 6 to 8 years to get back to even. As I mentioned, in the short term, you might be able to get a little pop out of fixed income, but your stocks and your equities are going to do the heavy lifting. So don't abandon the plan in the middle here because you've already taken a lot of the downturn. Now let's actually make it a little bit more realistic and look at the 60-40 portfolio. 60-40 portfolio, right? Many of you might be in a similar portfolio, maybe 50-50, 70-30, or 60-40, something in those lines. Equities to fixed income, so stocks to bonds. But if we look back over history, the last 4 decades, what has been the worst period in that time frame for a stock bond mix of 60-40? And then what was the next, 12 months to 3 years look like after that? Well, as you see here, over the last 5 decades, there's been considerable times in which a 60-40 portfolio was down. Many times in the mid-single digits, but other times in the 70s and 2000s, it was down meaningfully like we are now. What did the next 12 months look like? Well, in almost every period, the next 12 months after that downturn looks pretty good, looks pretty attractive. In the 70s, over 24%. In the 2000s, up over 34%. In the 2010, 13.5%. All healthy returns for a 60-40 portfolio following a drawdown, right? I don't say losses, I say drawdowns, because the market fluctuates up and down over time. Some drawdowns are larger than others and last longer, but drawdowns are part of investing. So when we look at this, we say, well, what do we look at 12 months or 36 months out? Those are pretty attractive returns.
Mm-hmm. So, kind of combining those last two slides there a little bit. So what that's, kind of telling us is based on what's happened in the past, based on history, with a 60-40 balanced portfolio or a moderate type of portfolio, typically speaking, that, drawdown would have, been recovered within 1 year, or, certainly when we look at the 3-year annualized, the gray bars there would have been recovered within that 3-year period as well, right? Yeah,
absolutely.
That's just another testament to, staying invested, making some adjustments, being proactive, but, the important thing to do during times like this is to stay invested as well.
Without a doubt, timing is not your friend. You're never going to get it right. As much as it might feel good to go to cash or do something dramatic, usually doesn't work out too well for most people. And as you see here, as I said in the previous slide, going to cash way would take you to earn back what you lost would take almost forever. And depending on what your time frame is, you might not have that. So again, in times of uncertainty, not making any drastic moves is probably the best move. Not making a change is actually a decision. So when you think about it and you say, okay, well, I need to do something. Not doing something is actually a decision, right? And that's something that, and then depending on what your conversations with Emmett and Marcus are, there might be ways in which you can take advantage of the current situation. When we look at volatility, as I mentioned, volatility is not going away. You might say to yourself, well, the market's been very, very volatile over the course of the last, call it a couple of weeks or several months. The answer is, yeah, it has, but it's not unlike any other year. So when we look at this is number of days the S&P 500 has dropped more than 1%. But volatility comes in two different ways. Volatility is not just downside volatility. Volatility also goes up, right? So when we think about this, if we actually added in the amount of S&P days or amount of days that the S&P was up more than 1%, it would also equally be as volatile, right? So if we look at it this year, we've had 50 days in which the S&P is down more than 1%. Is that a lot? Sure. But compare that to plenty of other days going back to the last 20 years, or calendar years going back to the last 20, and we've got good company. There's plenty of days in which the market or the S&P 500 has been down more than 1%. In fact, the average is 34 days. We're only slightly above that. Will we get a few more before the end of the year? I'm sure we will, but it's not to say that this year is any different from a volatility perspective than we've seen in other years. And remember, volatility is measured on both the upside and the downside. So don't just look at weeks and days and months in which the market's down a certain amount. Also look at how many days it's up. Just this last week, market's up. Had 2 days. I didn't look at it what it did today. But on Monday and Tuesday of this week, 2 days in which the market was up more than 1%. You look at last week, Monday and Tuesday, up more than 1%. So we've had 4 to 6 days just in the last 10 in which the market actually was volatile on the upside. And you need those to be invested on those up days in order for your to recover from those down days. Last but not least, when we talk about midterm elections, a lot of people will ask, well, what is the impact of the election? Honestly, doesn't really matter. It's great fodder. It's great coffee table talk. It's good, cocktail talk, but it doesn't really matter. We have elections in this country every 2 and 4 years, and it doesn't really matter the mix of what party either runs, doesn't run, or what the mix of the different branches of government are. We see returns in all different aspects. So when you think about it, don't get paralyzed by the elections, because for the most part, outside of tax policy, which, by the way, while it may affect the way you invest or how much money you actually end up in your pocket, does not affect the direction of the stock market. You may say, oh, the market sold off or went up based off these policy proposals. Yeah, in the short term, but in the long term, it doesn't really matter. So don't get wrapped around the axle when it comes to the elections. Again, we have elections in this country every 2 and 4 years. If you waited for an election result to invest, you never would, because then you'd be waiting on the next one. Same thing with events. We hear a lot of people say, well, there's just so much going on right now between interest rates and inflation and the crisis in Ukraine and China and Taiwan and all. And they say, well, what do you guys do about that? What do you think about that? there hasn't been a year in which we don't have 4 to 6 different major headlines or themes that are playing themselves out all at the same time. The investing graveyard is littered with headlines and potential events that could derail the market, and the market digests them. Sometimes they react, but eventually moves on. If you go back over the last 20 years, there's been no shortage of headlines and things that everybody's been worried about. But many times you wouldn't even be able to rattle them off at this point. But what's happening right now always feels like it's the worst, and we think it's different. Guess what? It's not. We'll move on in 2021, 2023. We'll have a new set of some will carry over and some will be gone, and we'll get new ones. So do not necessarily get too bothered by what's happening from a global perspective. Will portfolio managers and things like that adjust and maybe tweak and tilt based on some of that stuff? Absolutely. But is it going to affect is it going to have an impact on your investing lifetime? And no. What's going to have the biggest impact on your investment success is your behavior during times like this, not whether or not there's a crisis in Europe or energy prices are high or what the outcome of a midterm election is. Your behavior has the largest impact on your future investment accumulation and wealth. So with that, I will...
Sorry, before we wrap it up, just one thing on that last slide there. I hate to interrupt you again, but as I look at that, I see going back to 1934, the 12 months following midterm elections, every single one of those situations, we see positive returns, right? And obviously we see that, vary from, it looks like 5.2% up to about 48.3%. And, clearly we'd rather have the 48.3. But, if we, historically speaking, have never seen, negative returns following, midterm elections, that should, again, be another, positive indicator when we're looking 12 months into the future if we had a crystal ball as well, right?
Absolutely. And on top of that, if you said, okay, well, we have a positive return after the midterm elections, well, it actually didn't have anything to do with the midterm elections. It had to do with the economic cycle that we were in at that period of time. It just happened to coincide with after a midterm election. So, read the data however you want. It doesn't matter if you're sitting there thinking that what happens on November 8th, November 7th is going to have a major material impact. If you're sitting there, I'll wait to invest now, or I'll wait to do this, or wait to that. It wouldn't really matter because it's not going to have that much of an overall impact. So, yeah, you're right.
Awesome.
Right. So the numbers look great after a midterm election, but it's not usually because of the election. It's usually because of many other factors.
Right.
So when we think about just some of the broader themes, again, Marcus and Emmett are going to make sure that you guys get this slide deck so you'll be able to see some of the main points here, where we kind of go through the major economic views on the left-hand side, and then also discuss some of the specific asset classes. Again, the tilting and tweaking of different asset classes and exposures is something that your portfolio manager or Russell is going to do on the strategies, just at the margins. But again, from your perspective and from your interaction with Marcus and Emmett, it's going to come down to, right, sticking to your plan, what's your current situation, and your behavior during this period is going to be the biggest driver of your success. So with that, Emmett, Marcus, I know we're kind of at the bottom of the hour. I want to be cognizant of everybody's time. It's dinner time. Anything that I haven't missed, anything that I've missed, or that you want me to make sure I hit on, or questions?
Now would be a time to use the Q&A box if anybody does have any questions, looming out there. I just want to say, again, Tom, we really appreciate the info here tonight. And, looking at things like this, obviously this has been a trying year. You highlighted some of the difficulties we've had with equities. You highlighted the difficulties we've had with bonds, which, like you said, typically are that, safe haven or safety net. So, it's been a difficult year, thus far from an investment standpoint, but, that doesn't mean that we have more difficulty, ahead of us, right? It doesn't mean that we're, going to necessarily repeat, another drawdown in the coming, 12 months. Are we saying that we're at the bottom of the market? Absolutely not. We never know when that's going to happen. But, I think that there are certainly some reasons to be optimistic, when we look out 12, 24, 36 months down the road. And, you know, each of you that speak with Marcus and me on a regular basis know that, you know, if you say, hey, I've got this pot of money and I need it to be exactly here in 6 months, we're going to tell you keep that in cash, right? We're not going to have you investing for a 6-month period of time. So, you know, looking down the road, you know, sit back, ask yourself, do I think that the market's going to be higher, you know, in 2 years than it is right now, right? And if that's the case, you know, maybe it's time to take a look and just make sure that your portfolio is properly aligned for that as well. So I haven't seen any questions come through. Marcus, did you see any, or you have something to add here?
No, I didn't have any questions come through in the Q&A. I was curious if there was any sentiment in the area of taxes that Tom would like to shed light on. I know, you know, the strategies that Russell has within the tax efficient space is superb. So I just, you know, was curious if there was anything that he wanted to share in that area at all.
Yeah, I would just say to add on the tax side is, you know, obviously you play the cards that are dealt. And so right now, from a tax perspective, right, I don't know if necessarily everybody thinks that tax rates are going to go down. They're most likely going to go up from here. Actually, if nothing happens in the next Congress, rates will actually automatically go up as the Tax Cut and Jobs Act expires. I would just say, you know, be smart around your non-qualified portfolios. Your non-qualified portfolios, so your non-401k, your non-IRA, should be treated and should be managed a little bit differently than your 401k or your qualified assets. Why? Because of the tax impact to it. So be tax smart. Look for guidance around how to be tax smart or tax managed, because I think that is going to have, you know, if you can arbitrage the tax code and have your portfolio be a little bit more, you know, aligned to mitigate unnecessary taxes, that's just more money that you keep in your pocket that allows your portfolio to grow over time. And so just being tax smart, not tax oblivious, and making sure that you're aligning your non-qualified portfolios with some sort of strategy, whether it be Russell's or on others, that achieves that goal. So taxes are not insignificant when it comes to risks. We talk about market risk. We talk about all the other risks of a portfolio. Taxes are also a risk and can be a drag on your returns.
Awesome. Thank you. So again, no questions and answers. So we'll wrap it up here, and we thank you for your time. Tom, thank you so much for your partnership and leading us through this educational experience. And I was taking notes, so hopefully, you know, no one saw the top part of my head. I was too busy writing down. But one of the things I always take away, especially within investing, is just the value of time. Recently, I just, you know, picked up a small little hobby betting on Steelers games because I'm a big Steelers fan, and our probability of success for winning is not very high. But when you show me numbers like 71% chance or 73% chance of success with a 4 or 5 year time frame, which, you know, I believe most of the people on this call today have at least for retirement, that's a pretty, you know, high probability of success compared to something like 9% or something like that. So I don't want to miss the value that time provides, in addition to the decisions around staying invested and staying calm. So that's something I'm absolutely taking away from this as well. So thank you again, Tom. And that's my closing remarks. So thank you for those that stayed, and hope you have a blessed evening.
All right.
Thanks, everyone.
Great to see everybody. Thanks.